So retirement is generally a very touchy subject, I think, because a lot of people don't like thinking about getting older, or if they think being old is something in the future. But retirement planning is something essential because it allows you to be able to afford the lifestyle you're currently living today. And if you don't take the necessary steps towards saving for a retirement today, then you will be in for a very big surprise when you reach the retirement age. So that's what this webinar is about. We're trying to help our clients and investors in general become more aware about the landscape in Kenya when it comes to retirement benefit products, the different features, and how you choose a particular product over another one. So without much ado, I'd like to welcome Alice to the forum. Remember, you can use the Q&A tab in your screen to send us questions, and at the end of the session, we'll address them all. We also will be joined by our fellow colleagues, Ken and Caleb, to just help us address some of the concerns you may have. You can also use the chat function if there's something you would like, if you'd like to share with the team. Thank you.
Thank you, Damaris, for the introduction. Hi, everyone. My name is Damaris mentioned. I'm the product development department at Genghis, and I'll be taking you through just understanding retirement benefit space in Kenya and the products that are there, and what you should consider when you're looking for a retirement product. So allow me to just pull the presentation so we can go through it, and then we'll take your questions. Okay, we'll start. So this is basically what we're going to cover. The state of retirement currently in Kenya, the types of schemes that we have. That's what when you're saving towards retirement. And once you reach retirement, what options do you have? We'll also look at the governance structure just to understand how these schemes are set up. And also now we'll go to the conclusion, just tying everything together and maybe answer your questions after this. So we'll start with the state of retirement in Kenya. Basically, we look at the retirement benefit industry. This is just an industry that was formed to allow members to be able to, the working population, not even the working population, everyone above the age of 18 to start saving for your retirement. So the Retirement Benefit Authority was then formed in 2000. This was mainly to strengthen the governance of these schemes, to just ensure efficiency and protection of member benefits. Before the authority was formed, the schemes were characterized by a lot of misappropriation of members' funds. So by an act of parliament in 1997, the scheme was formed, now 3 years after the act of parliament. And the system itself has 3 pillars. The first one is the 0 pillar, which is the state-funded pension. This is basically for the retired population that require basic needs, yet they don't have a source of income. I think right now they do 2,000 per month. Yeah, the Ministry of Charges. This is managed by the Ministry of Social Protection. Sorry. And then the first pillar, we have the one that is mandatory for all workers. That is both the employer and the employee, and this is where the NSSF falls in. And then we have the second pillar, which is now voluntary. This is where the retirement benefit schemes fall in. This can be set up by employers, so you can belong to this by virtue of employment, and you can also join a personal scheme just by, even in the informal sector, you can just join a personal scheme. So in terms of overview of the retirement benefit industry, this is just how it has grown over the last, I think, this 12 years. You can see the growth has been tremendous, hitting about 1.3 trillion as of end of 2019. And even with this growth, we find that there's still a lot to be done in the industry, as the coverage is still less than 20% of the workforce. And I think now in the next slide, we look at the main challenges that this industry is facing. And the first and the biggest challenge is the penetration rate. So this the percentage of the working population that have a retirement plan, and we find it's about 20%. This data from research done by RBA, and this is equivalent to about only 3.2 million people, and this is 20% of the labor force. And we find that this is mostly due to the way the industry is set up. such that retirement is highly biased towards the people who are employed, where you belong to a scheme by virtue of formal employment, and your contribution is actually deducted from source. So we find that it's been harder to convince the people in informal employment to actively remit towards a retirement scheme and saving for retirement, where we find in the informal employment, the coverage is under 1%. And here is where the RBA has been challenging even the service providers, fund managers, to come up with very innovative products that will make it very efficient and attract even the huge population in the informal sector to just save for retirement, with their target being to increase this coverage to at least 30% by 2024. So another main challenge that this industry is facing is adequacy of pension. So we've seen only 20% of people are saving, and even those 20% that are saving, they're not saving enough to afford them a comfortable lifestyle at retirement. Again, data done by Zamara and RBA show that the current income replacement ratio in Kenya is about 34%. Against the recommended of 75%, and this ratio in developed countries is actually about 84%. So what we mean by income replacement ratio is how much your retirement benefits will afford you at retirement. So for example, if you're earning 100,000 pre-retirement, 34% income replacement ratio means your retirement saving will only afford you 34%. 34% of the 100,000, which is about 34,000 per month, which you find it's really not going to be able to sustain your lifestyle unless you now cut off and you're not now able to have the same lifestyle you had when you're employed. So the recommended is if you're earning 100,000 at retirement, your savings should be able to afford you at least 75,000 per month. And then we find this data also shows that more than 80% of senior citizens continue working. That's after 65 years, senior citizens are still working for basic needs. And this just raises more questions on how adequate is your pension. And it's just something to think about. So, and then now when you look at why don't people save for retirement, that's the biggest question. And this research also done by RBA suggests had the following findings, that the biggest reason why people don't save for retirement is distrust. They don't believe that you would save for, let's say you started saving at 25, and by the time you retire, maybe at 65, 40 years later, you'll be able to get these benefits. So the first one is distrust that the accumulated benefits will be there upon retirement. The second one is inadequate information, and then on the avenues that you can use for, to save for retirement. You find most people say, if I have property, if I have land, this can be my retirement plan. But when you look at retirement, you need to be very liquid, and also you need to diversify. Yes, it's okay to have land, but you also need an income, a retirement plan that will just ensure safety of your retirement. And then here we find that RBA has actually been very instrumental in member education. It has been going from town to town just to pass the information to members, because this is a huge challenge, people not knowing about how they can save for retirement. And we're hoping by this just continuous education, even by service providers through forums like this one, we'll be able to just get more people to appreciate retirement, to get away from the notion that it's only eligible maybe for the rich, which is also another reason why people don't save for retirement, say you don't have sufficient income. But if you're able to just budget with the income you have, retirement saving should be a critical aspect of your spending, and we believe everyone should be able to save for retirement just to ensure that you protect your sunset years. So and then we'll now go, when you're looking now to understand these schemes, we'll go to the type of schemes that are there in Kenya. Yeah, so schemes can be categorized in various ways, and the first one we're looking at is based on how you'll receive your payment at retirement. So you're saving in a fund, but how will you access the savings at retirement? So when you ask this question, you have two types of schemes. It can be a provident fund or a pension fund. And then the difference is, in a pension fund, you receive your retirement saving as a combination of a lump sum and periodic payments. So regulation stipulate that in a pension fund, you receive up to a third of your contributions as a lump sum. For example, if you've saved 3 million, you can take up to 1 million as a lump sum, and then the remaining 2/3, that's the remaining 2 million, can be transferred either to an income drawdown fund, or it can be transferred into an annuity. You can purchase an annuity, and then now this will continue paying you a regular income within your retirement, during your retirement years. That's a pension fund. A provident fund, on the other hand, will just pay you your benefits as a lump sum. So with a provident fund, you have more leeway and you have more options on what you want to do. So you'll receive your lump sum. Nothing stops you from also still taking that lump sum and purchasing an annuity that will pay you periodic payments through your retirement. Or you can still take that lump sum and transfer into an income drawdown fund and draw down as you draw down from that fund during your retirement years. So that's the main difference between pension fund and provident fund. And this is just how you receive your payments at retirement. So this is the first way of how you can classify a retirement scheme. And then this one, when you're looking at to choose between a provident and a pension fund, I think it's a personal decision. You just look at maybe if you have a regular source of income and you don't require maybe periodic payments, you can join a provident fund. If you have maybe a real estate that's affording you rental income, you can take a provident fund where at retirement you can take the lump sum and decide what you want to do with this money. You have more leeway and you have more control. In a pension fund, if you're it's just moderate risk, such that you won't let's say risk all your retirement saving, given that you can only withdraw up to a third as lump sum. Then if maybe you make a bad bet and invest maybe in something that won't pan out, you still have the 2/3 that is going to afford you retirement income. So it's a bit safer for you. So the second way how you categorize schemes is also based on the type of membership, like who can join that scheme. And with that, you can have either an individual fund or an umbrella fund or an occupational fund. We find the an individual scheme is where anyone can join. It's if you search, you'll see personal pension plan, individual pension plan. Those one anyone can join. In the formal sector, informal sector, you can just apply and join an individual retirement benefit scheme. An umbrella fund, on the other hand, this one you join by virtue of you belonging to a certain, being employed to an employer who has prescribed to that scheme. Maybe, for example, if you belong to a company which has joined, let's say, Zamara Umbrella Retirement Benefit Scheme and remits there, you'll automatically join that umbrella by virtue of you being in employment. So an umbrella scheme will just have, the members will be different companies just pulling their resources together on behalf of themselves and their employees. And then now when you go to, so you might find even in an umbrella, you might have 1,000 companies just belonging to the same umbrella scheme. When you go to an occupational scheme, the difference, it's also the difference between this and an umbrella scheme is that you also join this by virtue of you belonging to a certain employer, but now this one is set up for only one company. See, an umbrella, different companies can join the same scheme, but the occupational scheme, only one company can belong. For example, Kenya Power Pension Scheme. These mostly big companies are the ones that set these kind of funds because they're big enough and they have many members, so they're able to cater for the expenses of the fund. You can find like Safaricom has their own occupational scheme, KPLC, Kengen, these big companies, they do. And smaller companies are the one that join umbrella, because pooling the funds, it will even make it easier for the schemes to bear the cost, as opposed to a small company, let's say with 20 people forming its own scheme, and you have to pay the trustee fees, the custody fee, the administration fee. It will be a strain on the scheme, and ultimately we want to pass the maximum, the most returns to the members, so we minimize on the expenses. So the third way you can categorize a retirement benefit scheme is also based on mode of investment. So when you join a scheme, how are the funds invested? So here you can categorize a scheme as a segregated fund or a guaranteed fund. So the difference is in a segregated fund, the members' contribution are invested directly by a trustee. So the scheme has a trustee who will appoint a fund manager, and then the trustee will draw an investment policy statement that basically says, this is how you can invest the money. Do X% in maybe government securities, X% in real estate, X% in this and this. So ultimately is a trustee who is investing, but then now by drafting this document, the investment policy statement, and then appoints a fund manager to execute the investment policy statement. So here the fund manager will bring their expertise, because you see the trustee will say invest, let's say X% in property, but now the fund managers, they have to use their expertise to evaluate and find the best yielding assets to invest even within the class that is approved by the trustee. So the trustee appoints the fund manager to just use their expertise to invest the money and give the returns to the members. Also in a segregated fund, once you get the returns, everything is accrued to after the scheme expenses are deducted, everything is accrued to the members. And you'll see the difference between that and a guaranteed fund. Maybe if we talk about the guaranteed funds, these ones are offered by insurance companies, where the insurance company will just pull the funds from different members and invest, but it guarantees a minimum rate of return. Actually, I think right now the maximum you can guarantee is 4%. This means you can only tell people, I can give you, the maximum you can guarantee is 4%. But what happens is if you perform way above the 4%, you're able to top up with the bonus rate of return. So if you look at even performance by guaranteed funds over the last, I think 5 years, the average has been about 9%. But for segregated funds, the average has been about 11%. This is because in guaranteed funds also, once they calculate the returns for the scheme, maybe for a certain year, they'll pull sometimes some funds to put in reserve just to cushion the returns in case the next year the performance won't be as great, since they have already guaranteed a rate of return that they have to give to the members. On the segregated funds, on the other hand, they'll just, your returns is based on the market performance. In a good year, if the performance is 20%, you'll get the 20%. In a bad year, if it comes to 5%, you'll get the 5%. If it comes to 3%, that's what you'll get. So when you're looking to choose a scheme based on how the mode of investment is done, you consider factors such as risk appetite. So because you find guaranteed funds are about a bit safer if you want to cushion your savings from the volatility in the market. And for segregated funds, they are a bit riskier, but then also the high risk, high return, they benefit from the high risk, high return. And also you can consider something like age. So if you're approaching retirement, let's say you have like about 5 years to retirement, it's safer to join a guaranteed fund since you don't have the leeway to move with the market performance. But in a guaranteed fund, if you're young and you're investing in, you're looking to invest, you can consider segregated funds as you have a longer investment horizon, and you're able to go to, even if 1 year the fund performs badly, you're able to recover in the subsequent years. And as we have seen, ultimately segregated funds will have better returns than guaranteed funds. So those are the three we've looked at. Those are the options that, those are characteristics of schemes that you can join to save for retirement. But now after retirement, what options do you have? So you've been saving and it's time to retire. So you either take your lump sum or you take a third, and what do you do with the rest? So here we look at the options that you have at retirement. So at retirement, you can join an income drawdown or you can take an annuity. Basically, what is the definition of the two is that the income drawdown it's a scheme set up by the Retirement Benefits Authority. It's also regulated by RBA. So here you just transfer your accumulated benefits into this scheme. It's invested by a licensed fund manager, and then you'll draw down periodically from this scheme during your retirement years. it can be, it's a bit more flexible because you can choose how much you want to withdraw, how often you want to withdraw, and the minimum drawdown period is 10 years. So after the 10 years, you still have the leeway on what do you want to do with your funds. You can continue the drawdown if you're happy with your provider, or you can take the lump sum, or you can even now purchase an annuity. And then an annuity this also goes to the insurance company. So this is just a contract you have with an insurance company, where in exchange to your lump sum, now your retirement saving, you're given an annuity. And here you just have to engage a financial advisor, because there are different types of annuity, where you can purchase one that will pay you for the rest of your life. So no matter how long you live, it will pay you the agreed amount, maybe monthly, for the rest of your life. Or you can even choose one that will pay you, maybe, and your spouse, but now the monthly payouts will reduce, just because of you've added an additional person. So when you're choosing between an income drawdown and an annuity, there are factors that you can consider, and we look at those in the subsequent slides. So in terms of features of an income drawdown, so here's where our expertise is, because we are fund managers. These are funds set by fund managers. So some of the features is that the maximum drawdown percentage per year is 15% of the fund balance. This is capped this way by authority, just to ensure longevity, and to just ensure that you don't withdraw everything, and your savings are able to sustain you way into retirement. So if your savings it's 1%, is, let's say, 1 million, you're able to withdraw up to 15%, that is 150 per year of the fund that is remaining. So if the performance, let's say, is good, and next year maybe your fund has grown to 1.2, the 15% will be a bit more than the 150. Yeah, sorry. The minimum drawdown period is 10 years, such that when you join an income drawdown, you have to be there for 10 years. And then after the drawdown period, you can choose different options. You can take the remaining fund credit as a lump sum, or you can purchase an annuity, or you can even decide to continue with the drawdown period and subscribe for another 10 years. And then in terms of flexibility, we find that income drawdown is flexible, where you can choose how often you want to withdraw. You can say you want monthly payments, or you want quarterly, or even you want to just be doing once a year, or just any frequency that you may agree with your provider. It can even be every 2 months. So this one you just agree, as long as you don't withdraw more than the 15% per annum. So here is just a scenario of a person transferring, let's say, 2 million into an income drawdown. I had just a tentative start date. Let's say you start from 1st of January 2021, and you end after 10 years, that will be in 2030. So I assumed a moderate average interest rate of 11%. This is the average that the segregated funds have been performing. So I just took the average of 11%. And then what is varying is just the annual drawdown rate. So you can choose scenario 1, you can choose to be drawing down 10%. Scenario 2, you can choose to be drawing down 11%. Scenario 3, you choose to be drawing down 12%. Scenario 4, 13%. Scenario 5, 14%, and scenario 6, the maximum 15%. So you'll see, if you choose, let's say, the first one, the 2 million will be able to pay you about 16,000 per month for 10 years. And then at the end of the 10 years, your fund balance will be about 2.4 million. This is because you're withdrawing less than how the asset is performing. So you're withdrawing 10%, yet the interest rate is 11%. So at the end of the 10 years, you'll find that your fund has even grown. And you'll see the total amount that you have withdrawn actually in those 10 years, you'll be the 16,000, you multiply by the 10 years and multiply by 12, because it's every month. You'll actually have withdrawn 2 million, and your fund balance will still be about 2.4 million. If you take the second scenario, when your drawdown rate is 11%, your drawdown amount per month will be about 18,000. So in total, in 10 years, you'll have withdrawn 2.2 million, yet your fund balance will still be 2 million, because it's basically you're just withdrawing your interest there, because it's performing 11%, you're drawing down 11%. So ultimately at the end, your fund will be untouched. If you go to the third scenario, you're withdrawing 12%, the performance interest rate is 11%. So your drawdown amount is about 20,000 per month. So in 10 years, you'll have withdrawn about 2.4 million. Your fund balance will be at around 1.6. You go to scenario 4 at 13%. So you have monthly income of 21,000. Total in 10 years, you will have withdrawn 2.6 million, and the fund balance will be about 1.3 million. Scenario 5, your drawdown rate at 14%. So monthly, you'll be getting about 23,000. And then the total amount you'll have withdrawn in 10 years will be about 2.8 million. And at the end, your fund balance will be about 900,000. You take scenario 6, if you're withdrawing the maximum, that's 15%. You'll be getting about 25,000 per month. So in total, in 10 years, we'll have withdrawn about 3 million, yet the balance will be about 500,000. So this is just a basic of how income drawdowns work. Yeah. So then if you go to the comparing between income drawdown and annuity, you'll find that in terms of flexibility, an income drawdown is more flexible. As I mentioned, you choose how much you want to withdraw, how often you want to withdraw, and you can even change this. You can, for example, this year you can say I want to be withdrawing every month. When it comes to next year, you can say maybe I want to be withdrawing every 4 months or every 6 months. On the other hand, an annuity is not flexible. If you choose today an annuity that pays you, let's say, 10,000 per month for the rest of your life, that's it. You start with that for the rest of your life. In terms of income, income drawdown, you benefit from investment income, as this is the fund is invested by a fund manager, and so the interest is accrued to the member. So you benefit also from the investment income, and this might even grow your funds. So on the annuity, an interest, a rate of return is factored in when you're choosing an annuity, and this, you're stuck with this for the rest of the annuity period. See, an income drawdown, if it's a good year and there's high performance, your fund will grow. But on annuity, the conditions when you took the annuity, you just proceed with that for the rest of the time. In terms of longevity, you find that in income drawdown, here is where there has a downfall, because the income is not guaranteed to last a lifetime, because when you invest the funds, they come as they're affected by market performance. If it's a bad year and the performance is poor, it will also eat into your income drawdown fund. However, an annuity, depending on what you choose, you can choose one that will pay you for as long as you live. So in terms of risk appetite, an income drawdown is more risky, and an annuity is less risky. When you look at inheritance, maybe you want to leave your retirement saving for inheritance. So an income drawdown, in case of demise of a member, so your balance is paid to your nominated beneficiaries. So when you're joining an income drawdown, you'll nominate who your beneficiary is, and in case of anything, your fund balance is paid to your nominated beneficiary. On the other hand, an annuity, depending on which one you choose, some don't, where it's a single life annuity, where in case you die, the remaining of the funds, if you die maybe shorter after taking the annuity, remain with the insurance company. They don't pay anything to your beneficiaries. So we can look at the governance structure of retirement benefit schemes. So this is how the retirement schemes are set up. So a member joining a scheme, they join an already set and governed scheme, where you have a fund manager who basically the role of the fund manager is just to invest the funds according to the IPS, that the investment policy statement that has been drawn by the trustee. So we also have a trustee. Now the trustee is the legal owner of the fund. So basically the trustee will oversee the fund to ensure that it's run in line with the RBA regulation, just for the best interest of the members. The trustee also draws the investment policy statement that is to be used by the fund manager when investing the fund. So the legal owner of the fund is the trustee, and the beneficial owner is the members who join this fund. And then we also have a custodian. This is also a separate entity. So all these institutions are separate. So the fund manager is separate, the trustee is separate, the custodian is separate, and the administrator is separate. And this just to ensure good governance and just accountability also for the parties. So for the custodian, their role is just to safekeeping of the documents, and this includes the cash, the investments by the members. They also provide reports, just reporting on how the fund is being run and the assets that the fund holds. They report this to the trustee and also to the RBA. We also have an administrator who now just maintains all the member records, your beneficiaries, your details, your size of your retirement savings, because the fund manager will just get, let's say this umbrella scheme has this amount, but now the administrator will narrow it down to person A has invested, has saved this much, person B has saved this much. And then now all these people report to the Retirement Benefits Authority, which is now the authority that oversees this whole industry. It approves all the schemes and also just ensures every scheme that complies to the Retirement Benefits Act and regulations. So yeah, you can go to in conclusion, first we can look at the benefits of saving through a retirement benefit scheme. I think the first one and the biggest benefit is you enjoy compound interest. So I had a small assumption here. For example, a 25-year-old saving to retire at 60, that's why you have that 5 years horizon to save. You're making monthly contributions of about 3,000 and assumed interest rate of 11%. Again, I just took the average for the last 5 years. Your benefits at retirement will be about 12.3 million. But if you check, I can just calculate, you can actually just calculate how much you'll have put in, because that will be, you're putting in 3,000 per month. 3,000 per month. You have 12 months in a year, so you multiply by that by 12, and you have 35 years to retire. So in total, you have put in about 1.26 million, yet your retirement saving will be 12.3 million. Most people don't understand it, most people don't believe it, but that's the power of compound interest. Einstein is, okay, he said that compound interest is the biggest force in the universe, and he considered it the eighth wonder of the world. So basically your interest year one will form part of the principal year two, so it will earn interest for the second year. So this keeps compounding your, just growing your benefits and the amount that is attracting interest each and every year, such that you see you're able to save about 1.3 million and you get about 12.3 million at retirement. Yeah, so that's the power of compound interest, and saving through a retirement benefit scheme just affords you that benefit. The second benefit is you enjoy tax relief on your contribution. So if you're joining a scheme by virtue of employment, your pension deductions are deducted before your pay is calculated. So ultimately you pay less tax. And this is up to 20,000 per month or 30% of your salary, whichever is less. So you can only, you are able to get this benefit of up to 20,000. So if you're contributing 25, only 20 will be deducted before pay is calculated, and the other 5% after. So I get questions on how do you get this tax benefit if you're not in the formal employment, because you see, in formal employment, you contribute at source, but in formal employment, you remit from money that you have earned maybe from a business, which has already been taxed. So if you're in informal employment, you just claim this benefit when you're filing your returns at the end of the year. So you just put the amount that you've contributed to a retirement benefit scheme, and you're able to get the benefit. Okay. So what are the things that you look for when what do you consider when you're saving for retirement? I think the first thing is just to start today. So if you can begin saving as early as 18 years, but any age you can start saving. And because the longer you have to save, the longer your saving horizon, it will have a bigger impact on your retirement pot, and this will go a long way into improving the adequacy of your pension, just to ensure that it is able to afford you the same lifestyle that you'll have when you're working. So the second thing to look out for is just consider contributing into a post-retirement medical fund. You'll see even the regulations by the Retirement Benefits authorities that they have been updating them to ensure that every fund, you're able to contribute to a post-retirement medical fund. Because studies done show that the medical expenses form the biggest expenditure for retired people. With age, just becomes more complication. So you spend a lot on medical expenses. And in addition, most insurance companies won't cover elderly people, let's say above 50, 65 years, because they're considered risky. So you end up using a lot of your savings on medical expenses. But now if you contribute to a post-retirement medical scheme, you're able to just contribute to just money aside to afford you medical care at retirement. Also, I think regulation passed this that you can even transfer 10% of your savings in a normal retirement benefit scheme to a post-retirement medical, just to increase the size of your medical scheme. Another thing you can look out for is just have more than one retirement plan. So if you're in a scheme by virtue of employment, you can consider opening another scheme, a personal scheme, and just continue making a contribution towards your retirement and just improving on your retirement savings. Another thing you can look out for is just avoid cashing out your retirement saving once you leave or change employers. You find majority, about 95% of people will withdraw the maximum allowable benefits every time they change employers. And on average, people change employments between 4 and 7 times during their working years. So that means each time you leave employment, you withdraw. That is the maximum allowable is about 100% of your savings and 50% of your employer savings. So you're able to withdraw about 75% of your fund, remaining with 25%. So ultimately, at the time you retire, you find you still have a very small retirement pot that's not able to afford you a comfortable retirement. So just avoid, if you don't need the funds, just avoid cashing in on your retirement saving, because they're actually meant to be used at retirement. Another thing you can consider is just make additional voluntary contribution. Even if you belong to a scheme by virtue of employment, other than what is stipulated, you'll be contributing, let's say 5%, you can still make additional voluntary contribution. Say you have a bonus payment, you can just get a percentage and just add to your retirement saving, and this will just go a long way into improving your retirement benefits. And then I think lastly, I wanted to look at just a few regulations that have been amended that will affect this sector. And the first one, I think in this year's budget changes, they amended the regulations to allow members to access up to 40% of your retirement saving to purchase a house. So initially, the mortgage regulations allowed you to assign up to 60% of your retirement saving towards securing a mortgage. So you only assign, you don't actually withdraw this 60%. So you assign this as, let's say, deposit. If you're required to pay 10% deposit to get a house, and your 60% of your retirement saving can actually cover for that deposit, you assign this to get a mortgage. But money actually did not leave your retirement saving, because this is a secondary security. The first security is basically the house that you're buying, and property in this market mostly goes up. So there are very limited chances where they'll touch your retirement saving that you put as collateral for that mortgage. But now you can actually withdraw up to 40% of your savings, both yourself and the employers, to purchase a house. I think now the RBI is amending the regulation, the mortgage regulation, just to capture this and just to for it to be operational. Also, another regulatory change was in terms of post-retirement medical fund, where in the 2018-2019 budget changes, RBA amended to allow members of an umbrella scheme to make additional voluntary contribution towards saving for post-retirement medical fund. So initially, this option was only available for occupational schemes and individual schemes, but now it has been expanded even to umbrella schemes, where you can, in addition to saving for your retirement, you can also save for your medical expenses at retirement. It also, as I mentioned, allowed you to be able to transfer 10% of your savings into now the medical fund, just to have the desired level that you'd like to cater for the medical expenses. Another regulation that was passed, this was also in the 2018-2019 budget, was income drawdown. This was it made it mandatory for all schemes to provide income drawdown as an alternative to annuity or lump sum, as a channel in which you can access your retirement savings. So initially, it was not mandatory for schemes to have this, but the regulation changed it to ensure that each scheme, on their rules, on the trust deed and rules that is forming this scheme, to ensure that options on how you can withdraw your benefits, it includes income drawdown. So it allows you can just decide at retirement, you can transfer now the lump sum, the amount of money, into an income drawdown, and access now it as regular income in your retirement years. So this is what I heard in terms of how the retirement benefit sector is set up, how it looks like, and the type of schemes that are available. So maybe just a brief in terms of what we have at Genghis. We just have two products. We have an individual plan, which this one allows anyone to join. It's an individual pension scheme where anyone can join and make contributions towards retirement. And as I mentioned, if you look at who can join, anyone can join: self-employed, professionally employed, and SMEs. Anyone can join this scheme. In terms of features, it has a minimum contribution of 1,000 per month. And when you look at retirement, it's you access your accumulated contributions as a lump sum. You decide what to do with it. You can transfer into an annuity, you can transfer into an income drawdown, or you can take the lump sum and just make another investment decision. We also have an income drawdown fund. As I mentioned, this just gives an option for members to access their retirement savings as regular income during their retirement years. So an income drawdown fund can be joined by members who belong to a retirement benefit scheme. So you can't, let's say, sell a piece of land and say, this amount I'll take to an income drawdown fund. Money in an income drawdown fund has to come from another registered retirement benefit scheme. So who can join is someone who belongs to another retirement benefit scheme. At retirement, now they can transfer their savings into an income drawdown fund. So in terms of features, minimum contribution is $1 million. Drawdown period minimum is 10 years, after which you can decide to either take the lump sum of the remaining fund balance, or purchase an annuity, or continue with the drawdown period. And the maximum allowable drawdown percentage is 15% of the fund balance. So these are the two products that we have running at Genghis. And that's the end of my presentation. I think we'll take questions.
All right. Thank you so much, Alice. That was a very insightful presentation. I personally still learned a lot. I think for me, the biggest aha moment was the income drawdown scenario. So I think in such a situation, you just have to ensure that the amount you're drawing down is same or less than the interest that amount is generating if you don't want to draw into your principal amounts. So that was awesome. We have several questions, and some of our team members, Caleb and Ken, have been answering them, but I would just like to go through them for everyone who's in attendance. Well, I think the first thing to say is that this presentation that Alice has shared, as well as a recording of this webinar, will be sent out to all attendees. So you don't have to worry about taking notes or referring to a specific section. That will be emailed to you on the email address used for registration. So that's that. Now, I know Gaki, was it Gaki? Yes, Gaki had asked a question about the zero pillar, and I think, Alice, your video has gone off. So
Okay.
Gaki had asked if the zero pillar is applicable to all or just to civil servants. And I saw Caleb respond to the question. Maybe you want to add in something. Caleb was like, the zero pillar is applicable to all senior citizens. And an example is the Inua Jamii Senior Citizen Scheme that caters to citizens above the 70 years of age. Is there something you'd like to add on about the zero pillar?
Yeah, it actually applies to everyone. You just have to apply, and they will take everyone. It's based on need, it's on need basis. So they'll look at the really destitute population of the retired citizen. Those ones are the ones that are given priority when it comes to now with the Ministry of Social Protection. They are the ones that start getting the 2,000 per annum per month. Sorry.
Per month. Are they the ones who possibly don't have another retirement scheme, or the ones who don't have another source of income?
They don't have another source. Destitute, really destitute, because you can not have a retirement saving, but you have income somewhere else, maybe from rental or from a business. But now you see the senior citizens who don't have a source of income at all. They don't have maybe family to support them. These are the ones that are first priority considered when it comes to the Ministry of Social Protection.
Awesome. Thank you so much. Then another question was, Gaki also wanted to have examples of segregated funds. So could you give a couple of examples?
We can start with the Genghis Individual Pension Plan. It's a segregated fund. So if any fund that is mostly found by a fund manager, which is not an insurance company, it's a segregated fund. Guaranteed funds are only found by insurance companies. So like if we check the Britam scheme, it's a guaranteed fund. By being an insurance company, yeah.
Okay, awesome. Thank you so much. So if I go to the Q&A tab, I have a question from James Kiarie. James was asking if it's possible to open an IPP account with Genghis and transfer his deferred amount to it. And he got a response that, yes, that's very possible. And yes, James, we'll reach out to you via your registered email address and help you with that. Gloria was asking, or rather she was stating that she's retiring in the next 4 years. Can she start saving now for retirement?
Yes. Actually, the answer is yes. It's just yes, because it's never too late to start.
Yeah, it's never too late to start.
It's never too late to start. Even if you're retiring in the next 3 years, you can still start saving now, and it will just go a long way to improving your retirement. Yeah.
Okay. We had Matthew Ogutu asking, so I think there was a segment you were talking about if you're employed and there's a check-off system, or if you're in the informal employment, there's that whole check-off system. So Matthew wanted to know, how does it apply when you're in employment and you're also an employer as well? So do you need to save for that extra taxation? I think it was in terms of the amount that's tax exempt. Could you talk more about that?
So if I get your question, you're saying if you're an employer, actually an employer, you also get a tax benefit if you're remitting to a retirement benefit scheme. But now if you're an employer, this benefit goes to your employees, right? But if you're an employer and also you're drawing a salary and you're remitting to the retirement saving, also your pay is reduced by virtue of you contributing before pay is calculated.
Yeah.
Yeah, and also as I mentioned, in the informal sector, you get this benefit when you're filing your returns.
Okay.
Yeah, when you're filing your returns at the end of the year, you'll just indicate how much you have contributed to a registered retirement benefit scheme, and then you're able to claim these benefits. RBA actually refunds people, I think, at a certain amount. If you have it will reduce the tax you paid, and you can claim this to be paid back by RBA. So that's how you enjoy the tax benefit if you're in informal employment.
Okay, but let me just ask something. Let me use a real example like Damaris. Damaris is an employee of Genghis Capital. I contribute, let's say, 15,000 per month, right? And then on the side, I open my own individual pension plan, and there I save, let's say, 20,000. So 15,000 through my employer and 20,000 for myself, right? So the one for the so now when we talk about it tax exempt up to a max of 20K, how would you treat that scenario?
So, okay, when it goes to KRA, you're still one person. Your Damaris belonging to this umbrella, and also Damaris belonging to, same Damaris belonging to the individual pension plan. So if you've already been exempted up to 15,000 in the umbrella by virtue of employment, so then in the individual, you can only be exempted up to 5,000.
Ah, I get it. Okay.
Yeah, that's 20,000.
All right, that sounds great. Thank you so much for that. I think you and Caleb have a great synergy because you're responding in video and he's also chatting out the answers. I saw here another question from Joseph Suchi. He says, for the access to retirement savings to purchase a house, I think this is the new regulations, is it applicable to the actual construction of a house or is it just for purchase or mortgage?
Yeah, so actually, this is what we're waiting for RBA to amend their regulation, because initially in the mortgage regulation, you could access to purchase an actual house that has already been completed.
Okay.
So the amendment, we'll see if because RBA is now amending their rules to just make it practical. If you can access the 40% to construct, or you can access the 40% to buy off plan, or you can access the 40% to even to purchase a unit that has already been completed. So this one, when they look out on what RBA will update their regulations to say, and maybe we'll just do an article to update the market.
Awesome. Thank you so much for that. We have Winnie who's asking, or rather she's commenting, so I can't transfer a lump sum to get into the Genghis Income Drawdown Fund. Maybe you could restate that whole has to come from a scheme to the income drawdown.
Yes, the income drawdown guidelines, they stipulate that money in an income drawdown has to come from a registered pension scheme. So if the lump sum is coming from a scheme where you've been saving, you can transfer it into the income drawdown fund. But if it's from another source of income, let's say from a business or from a sale of an asset, that one cannot be transferred into an income drawdown fund. It has to come from another scheme.
Ah, understood. So if, for example, you stay with the Genghis individual pension plan and then you achieve retirement age, now you can transfer from the IPP to the IDD.
Exactly.
Okay. Winnie, I hope that has clarified the issue. And I think it kind of makes, okay, I don't want to say makes sense, but it's safeguarding because you only want it to benefit retirees, I think, for lack of a better term, not Damaris who's not yet in retirement age, but I want to take advantage of our income drawdown.
Yeah, exactly.
Okay. So another question which Caleb has also answered, Catherine Kihari had asked for examples of the post-retirement medical schemes. I think you talked about the fact that at retirement, medical bills are the biggest consumers of money for the elderly. So she just wanted a couple of examples. I know Caleb has given some by Sandlam Life and Minet, but could you speak more to this?
Yeah, actually, what most fund managers or sponsors, people who are setting up retirement scheme, are layering this into their scheme, the already existing scheme. So you'll find, for example, a Genghis pension individual pension plan also has a post-retirement medical fund. We're yet to set this up to layer this in our products, but you'll find most of the fund manager are setting the post-retirement benefit scheme inside the main retirement benefit scheme. I think NWealth does it. If you check the NWealth product, they also have a retirement post-retirement medical pension scheme. So most of them, just if you belong to a retirement scheme, you can ask if it already has a post-retirement medical, because what we're doing at Genghis will actually set it up inside our product. So you belong to the individual plan, and you can also because regulations say you're supposed to have your own investment policy as a post-medical retirement when you hit 50 million. So initially the funds can be invested and belong just to the same pension scheme, but they are now just segregated to pay for medical expenses at retirement.
Awesome. That's very clear. Helen is asking a question that I think plagues a lot of people when they start thinking about saving for retirement. So Helen Mashara is asking, back to the distrust factor, in spite of the governance structure, what can go wrong and cost her savings, which I think is a very valid concern. So Caleb had started to answer the question. Caleb says, unless a fund manager does not invest according to the stipulated guideline or there's a major unexpected event, there's usually no issue in terms of losing the savings, as pensions are risk averse by nature. Could you comment more on this?
Yes. So Caleb is very correct. So in terms of the governance structure put in place, it ensures that the risk is really minimized for members joining pensions, because this is a huge part, because it will just dictate how you retire and the quality of life you have at retirement. That's why they have diversification in terms of service providers, and also in addition to trustee oversight, there's also RBA oversight, and RBA has actually stipulated where you can invest members' money. So you can't invest outside what RBA has approved. And this goes a long way into ensuring a fund manager won't just go and invest in a very risky product and you lose all your money. So this just RBA regulation just ensures that you don't lose your money. Your money is invested in very safe assets. And in addition to RBA's investment guidelines, we also have a trustee. So the trustee will draw the investment policy statement. And this one also has to be in line with the RBA regulation. So let's say RBA has allowed up to 30% investment in property. The trustee can come and look at the scheme and say property is a bit high risk investment. The trustee can come and look at different factors. Let's say the age liability of the scheme, and see the median or the average age is about 55 years, meaning these people have about 5 years to retire. So you can't bet 30% in a property investment that is high risk. So they can come and say RBA has approved up to 30% to be invested in property, but I will only do 5%. So the fund manager will execute this 5%. So just the governance structure that has been put in place ensures that there's a lot of protection to member benefits and just really minimize the risk of you losing money.
Wow. Okay. Thank you so much. It's very clear. So I have a question here that maybe will rope in Caleb as well. Caroline Murimi was stating in the Q&A, she's already in a retirement fund. Some of her savings is put in what is being referred to as a tax allowable account, while the bulk is put in what is being termed as a non-tax allowable account. She wants to know what's the difference between these accounts. So I know Caleb had started answering this question in chat, but Caleb, would you unmute and have a discussion?
Sure. Thanks, Damaris. For this question on taxable account and the non-taxable account, given the tax-saving nature of pensions, the taxable account shows the portion of your pension which will be taxed upon your retirement. Basically, what the taxman will be subjecting to tax upon your retirement, while the non-taxable account is what will not be taxed. Even so, you're able to access the whole entire portion of that account upon your retirement.
Okay, I think that makes sense, because I know for retirement savings, like you said, there's a certain portion that's taxable at a specific tax bracket. So I guess where Caroline is saving, they have just segregated those two amounts.
Yeah, okay. Yeah. If I'm also to add, in terms of differentiated funds, you also have the tax exempt and the money that was not tax exempt. For example, if you're saving 30,000 per month, you're only tax exempt up to 20,000. So these 20,000 will go into the amount that has already been taxed, And then the 10,000 was not exempt. So it will go into the other category, and these are treated differently when it comes to retirement and taxation. So that is taxation when you're saving. There's amount that's already tax exempt, and there's a money that you've already paid tax for. So it has to be separated to ensure at retirement it's also treated, because you see the 20% you did not pay tax for, the 20,000, sorry, but the 10,000 you already paid tax for. So it will be treated differently at retirement. And then when you come to retirement, as Caleb was saying, this amount that you pay, I think regulation allow, you're exempt from tax up to a maximum of 60,000 per year for a maximum of 10 years. So if you've been saving for 15 years, you exempt from tax for 60,000 per year for the first 10 years. That's around 600,000. And then every addition is this, it's tax, I think there's a scale of how now they'll tax the above 600,000. But if you've been saving for, let's say, for 5 years, now your tax exempt will be the 60,000 times the 5 years that you've been saving. So that will be around 300,000, and then now the rest will be taxed according to the tax bracket that RBA has stipulated.
Thank you so much for that, Alice. I hope, Caroline, we've addressed your question. I think it's very important that whoever you're saving your retirement with, they have sessions such as this where they talk to you. Because what I'm learning is that there's a lot of things you need to be aware of, whether you're tax exempt, to how much, for how long. So it's really important for whoever you choose to be having conferences where they allow you to have this kind of questions. I think since we're talking about tax, there was a question in chat about what is the tax applicable to the income drawdown monthly payments, the ones you had talked about in your different scenarios?
So this one, first, I think you don't pay tax past 65 years. So if you join an income drawdown at the age of 65, you don't pay any tax. But if you join at 60, there's a tax, there's a graduated scale, depending on how much you withdraw, on how much tax you pay. So what we can do, maybe we can, I think this scale is in the RBA regulations, maybe we can extract it and share, because it's not standard, it's based on how much you're withdrawing. There's a scale that they apply, and this is up to 65. After 65, you don't pay any tax.
Okay, so they're applied together, so that's great to know. Joseph had a question in Q&A. He wants to know your take on NSSF. That's the National Pension Fund. He hears stories of pensioners not getting their funds or going through tedious bureaucratic processes to access the funds. Is there a way the fund can be better managed? What's your take? And I think I'd also like to hear from Ken, who's been quiet in panel after you.
Okay, hi all. Now, I see the question by Joseph. NSSF is not a bad idea. It's actually a very good idea. The only issue in the country as is things don't operate how they should operate. So for example, efficiency in other countries, NSSF, if you were to have another country, maybe a first world country, NSSF would be a very good idea. My mother retired last year and she had to wait for almost 1 year to get her pension. So it's a good idea. The only thing is in Kenya, it's not working as should be happening. Yeah. And there are so many things. If you go and look at the board for NSSF, you'll see so many political interests over there, which makes it become a very tricky thing. Unfortunately, we all have to pay our dues to NSSF. Yeah. We all, on a monthly basis, you have to, if you're employed actually, it's like tax you have to pay. Yeah.
Okay, so what I'm hearing is that the dream is good, but the reality is something quite different. Thanks, Ken.
Exactly.
All right. Alice, is there something you'd like to add on to this as we come towards the end of our session?
For NSSF, I think they have been working towards improving efficiency, but I don't think they're still there. I think they even had a USSD, but I don't know anyone who has ever accessed their benefits from retirement from NSSF, so I'm not one to vouch for them as of now. But I think it's just a lot of bureaucracy. I can mention maybe political interest and governance, just management of the fund in terms of maybe trustees. Yeah.
All right. So I think for everyone, what we need to realize is that you can't just depend on NSSF. You need to have your own personal prerogatives. So whether it's through your employer or opening your own individual pension plan, you need to like take back your power and just save for your retirement. And at least the NSSF contribution is not so much higher. I don't think it cripples you from also saving for your own pension. So I believe we're coming towards the end of the session. I haven't seen any more new questions under Q&A. And I believe I have addressed all the questions in chat. If I haven't, you can go ahead and just prompt me. What I just wanted to restate is that we're going to share the recording, the link to this recording to everyone who registered for the webinar. You'll also get a link to the PDF version of the presentation just so that you can read through. In addition, later this afternoon, I'm going to send an email to all attendees and copy our financial advisors, copy Alice in that email. So if you want to continue the conversation like Winnie does, or Gloria or James, feel free to just reply to that particular email, and then we can continue this conversation. We're happy to share additional information, clarification, so please take advantage of that. As I spoke, I saw a couple of questions to us. You need to apply to get paid, NSSF, make a claim. So Matthew is giving us some advice. Like if you're having issues with NSSF, make an application to be paid. Matthew, do you work with NSSF? But it's good to know. It's good to know. So thank you for that. Alice, I just wanted to say a big thank you. Do you have closing remarks as we come to the end of our webinar?
Maybe just say thank you for everyone who logged in, and to encourage everyone to just take charge of your retirement. We'll continue having these forums just to educate the public. Also, RBA is very keen on member education. Just if you have any question, as Damari said, just feel free to reach out to us, and let's take charge of your retirement.
All right, thank you so much. All right, thank you so much, Alice. Thank you so much, Caleb and attendees. Thank you very much for attending the session. We'll see you very soon. Have a good afternoon.
Okay, thank you all.
Thank you all.